Ever wondered how just one single number can have this massive pull over the entire Indian stock market? Well, that's exactly what we're diving into today. It's this powerful but actually pretty simple relationship that can make all the difference.
Yeah, I mean, how can one little lever, one single number, create these huge waves across the Sensex and the Nifty? It seems kind of crazy, right? But that's the puzzle we're going to solve right now.
And here it is, the big one, the repo rate. Now, just think of this as the wholesale price of money. It's the interest rate the Reserve Bank of India, the RBI, charges other banks. And believe me, that rate trickles down and ends up affecting, well, everything, from the loan on your house to the health of the entire economy. So, to really get a grip on its impact, let's use a really simple picture. Imagine a seesaw. On one end, you've got interest rates, and on the other, the stock market. Because, when it comes to these two, it's a classic seesaw dynamic. One side goes up, the other almost always goes down. Okay, so the basic rule of thumb is super straightforward. When the RBI decides to hike interest rates, the stock market usually takes a hit. But when they cut rates, the market tends to climb. It's this inverse relationship, and it's been incredibly consistent over the years. The real question, though, is why? Why does this happen like clockwork?
All right, let's pull back the curtain and see what's actually making this seesaw move. It really comes down to three main reasons.
And we're going to look at this from three different angles. First, through the eyes of a company. Then we'll put on our financial analyst hat. And finally, we'll see it from the perspective of a regular investor, just like you or me. Each angle gives us a crucial piece of the puzzle. Okay, first up, let's put ourselves in the CEO's chair. You see, most companies rely on loans to expand, to operate, to do, well, anything. So when the repo rate climbs, the cost of their loans goes up, and that eats directly into their profits, right? Their bottom line gets squeezed. And since the stock's price is basically a bet on its future earnings, if those future earnings look smaller, investors just aren't willing to pay as much for the stock. It's a pretty clear cause and effect chain. Next, let's get a little technical and talk about valuation. Now, here's a core idea in finance. A rupee you expect to get a year from now is worth less than a rupee in your pocket today, right? So analysts use this thing called a discount rate to figure out what those future earnings are worth in today's money. And guess what that discount rate is tied to? Yep, interest rates. So when interest rates go up, the value of all of a company's future profits, when calculated in today's terms, suddenly looks smaller. It's wild. The company could be firing on all cylinders, but because of this math, its stock just looks less valuable. And finally, reason number 3 is all about us, human behavior. Just think about it. When interest rates are high, why would you risk your hard-earned money in the choppy waters of the stock market, especially when a super safe fixed deposit is offering you a fantastic, guaranteed return? It's a no-brainer for a lot of people, so money just flows out of stocks. But flip that scenario. When rates are low, those same safe FDs are giving you peanuts. So where do you go to find better returns? You guessed it. You're pushed towards the stock market. It's a simple case of where does my money work hardest? Okay, so that's the theory, right? It makes sense on paper. But does it actually play out like this in the real world? Well, let's jump in a time machine and look back at the last 20 years of the Indian market. We're about to see this seesaw in action, for real. And wow, when you look at it like this, the pattern is just crystal clear. Look back at 2008. Rates were climbing right before the global financial crisis hit. Then check out 2010. Rates get slashed and boom, a strong recovery. Let's fast forward to 2021. Rates hit rock bottom, and what happened? An absolutely unprecedented market rally. The connection here? It's impossible to ignore. Let's just pause on that 2008 number for a second. 9%. That was the peak repo rate in 2 decades, and it happened at the exact same time the entire global financial system was basically on fire. It's a perfect example of how sky-high rates can really put the brakes on the market, creating this super restrictive environment. And then you have the complete opposite end of the spectrum, the floor, 4%. This historic low, right in the middle of the pandemic, was like pouring rocket fuel on the stock market. Suddenly, borrowing was dirt cheap for companies, and for millions of new investors, their savings accounts were earning basically zero, so they poured into the market looking for any kind of return. Now, it's important to note that this whole seesaw effect doesn't hit every part of the market equally. Some sectors are way more sensitive than others. Take a look at this data. For every 1% the RBI raises the repo rate, private bank stocks, on average, drop by almost the same amount in the short run. And other sectors like real estate, which relies so heavily on loans, they feel that pinch almost instantly. So we've walked through the why, and we've seen the history. So what's the bottom line for you? What should you really take away from this whole market seesaw dynamic?
Here's what it all boils down to. The RBI's rate announcements are one of the most powerful signals you can get for the stock market. This whole up and down seesaw thing, it's not magic. It's a predictable result of real-world stuff. How much it costs companies to borrow, how we value stocks, and just plain old human psychology. And it's a pattern that has held up for decades.
And that brings us to the big, forward-looking question. We've seen how this inverse rule has basically written the story of the market for the last 20 years. But as we stare down the barrel of all these new global economic challenges, you have to wonder, will this simple seesaw relationship still hold true for the next 20 years? Now that's something to think about.